Right now, property owners are sitting on record amounts of equity, but for a growing segment, that wealth remains trapped behind an antiquated banking system. Traditional home equity lines of credit, or HELOCs, were designed for a very specific, rigid profile: W-2 wage earners who hold their property in their personal names. The problem is, modern home ownership doesn't look like that anymore. Today's reality includes fluctuating gig economy income, self-employment, and investment properties held inside LLCs. Put traditional bank expectations side by side with the modern borrower's reality, and the mismatch is obvious. If you don't fit the mold, you hit choke points: 45-day waiting periods, invasive appraisals, and strict underwriting. To bypass these specific hurdles, alternative lending pathways like the 5-day Digital HELOC were developed. Because having high equity is practically useless if the friction required to access it prevents you from moving on a time-sensitive opportunity. This digital agility tool solves real problems, but let's be clear, it isn't necessary for everyone. To see if you need this product, we evaluate 3 profiles. First, the real estate investor needing speed and LLC flexibility. Second, the self-employed entrepreneur, penalized for legal tax write-offs. Third, the over-leveraged homeowner, rejected for high debt-to-income ratios. Let's analyze how the Digital HELOC changes the trade-off calculus for each of these 3 scenarios. For the real estate investor, the primary enemies are slow banking timelines and the strict requirement to hold a property in a personal name. The digital product tackles the timeline issue by bypassing the traditional in-person walkthrough appraisal. Instead, it uses an automated valuation model or desktop appraisal. This approval badge shows what happens when you remove that manual step. Investors can achieve a clear-to-close in a matter of days, rather than waiting through a standard 45-day cycle. The trade-off for this massive increase in speed is that the automated valuation might come in slightly more conservative than what a local in-person appraiser might calculate. The second feature is critical for asset protection. The lender permits the title of the home to remain under an LLC. This preserves your corporate veil and limits your liability. In exchange, you will have to present properly organized LLC operating agreements during the underwriting phase. If you are an active investor, the velocity of capital required to win a competitive bid far outweighs the cost of a conservative valuation. Now let's look at the self-employed entrepreneur. Their main friction point is the tax return penalty. Heavy business deductions make them look unprofitable on paper, causing traditional banks to deny them. The solution built for this profile uses 12 to 24 months of business bank statements to verify income, entirely replacing standard tax returns. By doing this, the underwriting is based on your actual, real-world cash flow, providing an accurate reflection of your true purchasing power. To unlock this capital, there is a required trade-off. You have to submit to deep lender scrutiny of your entire business cash flow history, fully revealing all incoming and outgoing business expenses. Traditional banks refuse to do this because it requires specialized manual underwriting. They find it too complex and expensive to process at a massive scale. But by using this alternative pathway, smart tax deduction strategies go from being a lending liability to a total non-issue. Finally, we have the over-leveraged homeowner. They have high equity, but they are blocked from traditional refinancing because their credit card balances have pushed their debt-to-income ratio too high. The mechanism here relies on rapidly liquidating that trapped equity, using total household income parameters to satisfy the underwriting requirements. This allows the borrower to immediately pay off high-interest revolving credit card debt, resulting in a single, much lower blended monthly debt payment. But the trade-off is severe. You are taking unsecured debt and securing it against your primary residence. The stakes change entirely. Missing payments on unsecured debt ruins your credit score. Missing payments on a HELOC puts your actual home at risk of foreclosure. While this is a highly effective rescue maneuver to free up cash flow, strict, disciplined financial behavior is absolutely mandatory once consolidation is complete. So, does the effort and trade-off of a 5-day digital HELOC yield a positive ROI for your specific situation? Let's map out the final recommendations on the scorecard. Avoid this product if you're a standard W-2 employee with no urgency. Your property is in your personal name, and you can wait 45 days for a lower rate. It is the perfect tool if you are an investor who needs to access funds in under 14 days, or if you hold your property inside an LLC. It's also built for self-employed professionals who rely heavily on 1099 or non-traditional income documentation, And it is highly effective for homeowners who require rapid execution to aggressively consolidate high-interest debt and generate an immediate return on their monthly cash flow. The 5-day Digital HELOC is designed to remove the structural friction keeping your wealth trapped, shifting from traditional banking bureaucracy to modern financial agility.